Money creation. Money is essential to our daily lives, yet many of us don't fully understand how it's created. In this video, we'll explain the basics of money creation, so you can have a better understanding of how money works and where it comes from. Why do we need to create money supply? Creating money supply is necessary to facilitate economic growth and stability. Money serves as a medium of exchange, allowing individuals to trade goods and services without the need for bartering. When money supply is increased, it allows for greater economic activity, as more money is available to be spent on goods and services. This can stimulate economic growth and job creation. On the other hand, if there is a shortage of money supply, it can lead to a decrease in economic activity and potentially cause a recession. Key player: the Federal Reserve. To understand money creation, we first need to understand the role of the Federal Reserve. The Federal Reserve is the central bank of the United States, and it has the responsibility of regulating the country's money supply. It does this by setting monetary policy, which includes controlling interest rates and managing the supply of money in circulation. Open market operation. The Federal Reserve creates money through a process called open market operations. This involves buying government securities, such as treasury bonds, from banks and other financial institutions. When the Federal Reserve buys these securities, it credits the seller's account with new money. This new money is then added to the overall money supply. The Fractional Reserve System. One of the key tools the Federal Reserve uses to manage the money supply is the Fractional Reserve System. This system allows banks to hold a fraction of the deposits they receive in reserve and lend out the rest. For example, if a bank has a reserve requirement of 10%, it can lend out 90% of the deposits it receives. This creates new money in the economy, as the borrower receives funds that did not previously exist. Money multiplier effect. This process of lending and creating new money is known as the money multiplier effect. It occurs because the funds that are lent out are often redeposited into the banking system, where they can be lent out again. This cycle continues, with each round of lending creating new money and expanding the money supply. The other side of the coin. The Federal Reserves and the Fractional Reserve System both functions to maintain the economy. However, the act of money creation is literally putting zeros into a system, really out of thin air. Criticisms and limitations. While the Fractional Reserve System has been a key tool for managing the money supply, it has also faced criticism and limitations. One concern is that it can contribute to inflation, as the increased money supply can lead to a decrease in the value of the currency. Another concern is that it can lead to financial instability, as banks may engage in excessive lending and become over-leveraged. In conclusion, the process of money creation in the United States is a complex and important part of the economy. Understanding how it works is crucial for policymakers and citizens alike, as it affects everything from interest rates to inflation. Thank you for watching. Please press like and subscribe for more contents like this.